Today I'll talk about getting a whole life insurance policy specifically for infinite banking. We'll go over different products that are often shown to individuals, and then I'll go through an example of using a policy specifically in the form of a loan, and we'll go over how that loan impacts the life insurance policy if we pay the loan back, don't pay it back, or pay interest only. What we'll start with, though, are different product options, and the goal is to see how you can get as much cash value as possible. So when it comes to whole life insurance, there are a lot of different products available. We're going to go through two types. The first is what is called a traditional whole life insurance product. This is often referred to as a whole life 100, could be a whole life 121, and what that number represents, 100, is the age that premiums are contractually due until. So what that means is if you buy a whole life 100 policy, the premium in your life insurance policy is contractually due until you are 100 years old. Now, why this product is often sold is one, many people in the infinite banking space believe that you should have a whole life insurance policy where you can pay as much money for as long as possible. That's one reason why. Another reason why, this one's my opinion, is that the agent commissions are the highest on these products when you compare them to all other whole life insurance products. It's a fact. It's how it works. So this product is commonly sold. The last thing I want to mention is while the base premium is contractually due until I'm 100 years old, it does not mean that I have to pay into it until I'm 100 years old. You'll see an example of that in a little bit. But that's the most common type of life insurance policy that's sold. And then we also have a limited pay product. In this example, a 15-pay policy. Now, a 15-pay policy means that premiums are due for a maximum of guess how many years? 15 years. It is a limited pay product, meaning that the premiums are due for a limited number of years. Now, like the whole life 100 product, where you do not have to pay into it until you're 100 years old, with a 15-pay product, you do not have to pay into it for 15 years. You can stop early if you'd like. But those are the two types of products we are going to analyze. And what I will say is when you look at different products, it is important to understand how the insurance company positions the product. For example, we're going to look at MassMutual. MassMutual, like many life insurance companies, positions their whole life 100 product for death benefit first and cash value second. Meaning if you were to compare the whole life 100 with every other product that's available from MassMutual, the cash value would look the worst on the whole life 100 product, assuming it's an apples to apples comparison, where all policies are designed with the same base premium, PUA ratios, and cash value is the goal. But this product is the most commonly type of whole life insurance product sold, and it's also not going to generate the most cash value. A lot of times, people don't know that, including some of my peers in the business. Then, the limited pay product generates the highest cash value. Now, if we focus on MassMutual, they have a 10-pay product, which does deliver stronger cash value than their 15-pay product. A little bit more, but their 10-pay is the strongest. We're going to look at funding a policy for 15 years, which is why we're looking at the 15-pay in this example. So as we look at these two products, here's what I want to start with. And let's assume your goal is cash value. That's why you're putting money into the policy. When you pay money in, your money can go toward either the base premium or toward your paid up additions rider. With a whole life 100 product focusing on this specific option, money you pay toward the premium will give you 0 in cash value in the first and second year. Beginning the third year, you'll see any money that you're paying toward the premium come back to cash value for you, begin to earn dividends and interest, and it will get better and better. But the first and second year, you've got a goose egg, nothing. The reason why is because premium dollars primarily satisfy your death benefit. Whereas money you pay into your paid up additions rider will make you feel like this. because you see the bulk of that payment is typically somewhere between 90 and 95% show up in cash value immediately. It's money that you can access. PUA dollars do get you some death benefit, but why people put money here is for the cash value. Like, that's what they're interested in. The limited pay product. Here's the difference. Money you pay toward the base premium. You won't see a zero show up in cash value. Depending on the product, if I look at a 15 or a 10 pay product, I'm usually going to see somewhere between 25 and 35% of the base premium show up in cash value. With the 15 pay product, it's going to be closer to 25%. A 10 pay product will be closer to 30 to 35% of my base premium payment that shows up in cash value. That will give me a richer upfront cash value, and then also because the insurance company designs the product in a manner to give you more cash value, it's going to give you more long-term cash value as well. Now, premium dollars still prioritize the death benefit, so what we'll do is put as much money as we can toward the PUA rider, which makes us happy because it builds cash value. It does get us some death benefit as well, but it is small relative to the base premium. So here's the plan that we're going to look at in this case. We've got an individual who is 35 years old. He is interested in funding $30,000 per year. Notice the two words in between fund and 30,000. Funding up to $30,000 per year, meaning he does not want to be committed to this. Now, he wants to stop the funding at age 50, but he also wants the option to adjust the funding amount. While he thinks he can hit $30K per year, if he is obligated to pay that much every single year, it's going to stress him out, and it's not going to accommodate his goals. So we are going to build it to be as flexible as possible. This way, he can adjust the funding every year if he wants. And I'll go over the minimums and maximums with the different options. He also wants the option to stop funding altogether if life happens or he just decides, I want something different. All right, so let's take a look at the numbers, shall we? We'll start with an old school Whole Life 100 product. This is an excellent example of exactly what you should not do if you're interested in a life insurance policy for high cash value. However, it will be beneficial to walk through here. So again, we've got a Whole Life 100. This is on a 35-year-old male. And this example will have nothing going toward your PUA rider. So as we look at this, you've got $30K per year going in for 15 years. That is your out-of-pocket. All of your payment is directed toward the base premium, meaning zero of your payment is directed toward the PUA rider. With a traditional Whole Life 100 product, and this is the case with most life insurance companies, you're going to see, look at that, zero in cash value in the first year. Now, with this product, it's zero in cash value in the first and second year. Here, we are getting a small dividend beginning the second year, which is why we see something in cash value. Might as well be zero. I've paid in 60 grand and I've got 2,700 bucks to show for it. Like, oh, man, that's a hit. 10 years in, he's paid in 300,000, he's got 342. By the 15th year, he's paid in 450, he's got 485. To be very clear, I would not recommend this. And this is also not what is typically sold for infinite banking. I've seen some people do it. There's my old boss many, many years ago, before I was at the executive benefits planning firm, would sell policies like this. And I remember one time sitting in the meeting with him, he's meeting with someone and said, this is a high cash value policy. It's different than the other policy you had, because he had sold the person we were meeting with a Guardian policy years ago. Then he was showing him a Mass Mutual policy. And the guy asked, what's the difference between the two? And he said, this one's high cash value. It had zero in cash value in the first year. So my point is, some people will call it high cash value, but it's not. I was young and didn't know much at the time, but I would not advise that for a client. Let's look at the exact same product with the exact same out-of-pocket, but designed for high cash value, kind of. So this is typically what we see in the infinite banking world. Not by everybody, but it's quite common. So your out-of-pocket is the same $30K per year for 15 years when we look at it here. Okay, there we go. First year is not a zero. It's about $18,000. Much better, isn't it? Why? Where's my money going? Up here is your base premium. It's not $30K. It's $11,000. And then here, Ayler, is your PUA rider, $19,000. So you're right around, what, 36, 37% of your total payment is directed toward the base premium. The PUA payment is really what's driving the cash value, especially in the first and second year. Now, with the exact same product and just making some slight tweaks on the policy design, what's the difference to you? Do you remember what the year 15 cash value was in the first example? It was $485,000. Here, it's $565,000. And this is still a traditional product. So a lot of times, people are sold this type of product, which I'm not a fan of because it's not good. It looks a lot better than what we just saw, but it's not good. Here's the thing about this particular design. With this base premium down here of $11,000, that is as low as we could drive it without attaching a term insurance rider while still paying in $30K per year. Here's why. Your MEC limit is about $30,000. Your MEC limit, MEC stands for Modified Endowment Contract. It represents a taxable event with a life insurance policy. That is, if your policy becomes a MEC. Your MEC limit is the maximum dollar amount you can pay into a policy per year and have the IRS still view it as life insurance and not a modified endowment contract or a taxable event where we've got to deal with taxes on the cash value if we ever access it. So what we see quite a bit in the infinite banking and bank on yourself world are policies like this without a term insurance rider and a high base premium. My opinion is that I think not using a term rider is an excuse to drive the high base premium. Some say, well, it gives you the ability to pay in more money for a longer period of time. Yeah, I'm like, no, I don't buy that at all. I think you're just trying to upsell a high base premium because what happens to most people is they don't pay a ton of money in for a long period of time. Most people want to stop. And even with that said, I should say most people want to stop after they've started. Several years in, they change their mind. But even with that said, you can set up a policy with a much lower base premium, much higher cash value, and still pay into it for a long period of time at the same dollar amount you could with the high base premium. With all of that said, here's what we looked at, or what we're going to look at next. There's your 15-pay policy. Okay, if we scroll down to the number pages, here we go. What do you notice about this? Your out-of-pocket of $30K per year is exactly the same. And it's exactly the same for the same 15-year period. The difference is when we look at that $30,000, we're not just using a product that delivers more cash value, but we're shrinking that premium even more, down to $3,000, or 10% of the total payment, which is about as low as we could push it with this company and product. Pushing it to the minimum, man. Minimize expenses, maximize cash value. So when we look at maximizing it, like, here's what it does. Total cash value, $27,000 in the first year. By the fourth year, you paid in how much? 30 times 4 is 120, and you have 120. So by minimizing those expenses, we are maximizing the cash value. Now, when you look at all of these riders here, we've got a lot more going on. What it is a combination of PUAs, that's where the majority is going, and then also term insurance. The purpose of term insurance rider is that it is a cheap way, if you don't like the word cheap, cost-effective way to raise the death benefit, which raises the MEC limit. So again, we've got a policy with a minimum death benefit in order to be able to fund up to $30,000 per year. If you want to carry a minimum base premium, you will need a term insurance rider. If you hear something along the lines that if you add a term insurance rider, specifically a one-year term rider, the policy will blow up, that's nonsense. Corporations have followed this model forever since I had a role of designing policies for them, and this rider was actually rolled out in the early 90s with most life insurance companies, and corporations have been using it since then. As long as you've got an agent that's monitoring the policy, you'll be fine. Typically, I hear that term, it's going to blow up. It's like a universal life insurance policy from agents that want to sell a higher base premium. That's where I see it the most. Could be another reason, but it's like, just be responsible and look at the policy. That's all you got to do, man. All right, anyway, sorry for my tangent there. Here is the 15-pay policy. Let's look at all of this side by side, and then we'll look at some loan examples. Sound good? Okay. So here's the traditional whole life product. That's the Whole Life 100. When we look at this, first year cash value, about $18K. This is the first illustration we looked at with Mass, by the way. $30K per year. Break-even point, year 9, where I've paid in $270 and I have $273. All years prior to that, I have less than what I have paid into the policy. That's what my break-even represents. The first year, my cash value is greater than my total payments. Okay, the good one. Here we go, 15-pay product. Same company, by the way, right? Same company, same funding, different product and design. So the difference in the product is that we're using a 15-pay product, and the difference in the design is that we are reducing that base premium as low as we can to $3,000. Now, this says PUA, $27,000. It's closer to $26,500 or so because a portion of that $27,000 is satisfying the cost of that term insurance rider we have attached to the policy. But even with that term, there you go, break-even point, clean year 4. So you, the policyholder, are paying the exact same dollar amount out of pocket for a 15-year period. There's the difference in cash value. It's quite massive, isn't it? As you scroll down, that difference just gets greater and greater in favor of the 15-pay product. And the reason why is because we're using a product that is designed for cash accumulation first and death benefit second, which means an insurance company will pay a lower commission. That is how it works. And then second, we are reducing the base premium, which also means the insurance company will pay a lower commission. I state that just to express the fact that in the life insurance industry, when individuals are interested in getting a product for cash value, there is a bit of a conflict of interest. You may have noticed I've been a bit more vocal of that of late because I don't really like talking about commissions. The reason why is I feel like I've seen so many cases lately of people coming to us saying, here's the policy that I already bought, and the premium was ridiculously high with a company and product that we wouldn't recommend where the commission's high, and then it was at the consumer's expense. And they were like, I wanted cash value. That's why I got this policy with this other agent. Is it done right? It's like, you could have more cash value. Now, I don't know the conversations that transpire between the individual and the agent. Every conversation is unique. But if I'm interested in cash value, like, show the different options. How I like to progress through this is not just show you one or two options and say, which one do you like? It's like, no, here's 2 different options. With this option, you've got the option to continue to pay the premium beyond the 15th year if you'd like. Whereas with this option, you can fund it for a maximum of 15 years. In 15 years, you'll be 50 years old. Based on what you're doing with your business and perhaps your real estate investments, whatever your situation is, do you think that you'll want to fund more than 15 years? And if you do, would you want to continue to add it with the same policy? Or would you want to look at a new policy? If we look at a new one, remember that our health could change over time. I'll have a conversation about that and then show different options with different companies and products that other people in a position similar to you had considered. The thing is, people typically don't know what questions to ask when they're researching this because they're new. So if they're not doing the research and asking the questions, I'm going to do my best to ask the questions for them. This way they feel informed and they're comfortable and we're actually working on a plan, not just saying, go with this product. All right, so that's funding it for 15 years, side by side. A comparison, hopefully an in-depth comparison, I know I went through a lot there, of seeing what it looks like if I fund up to $30K per year and stop the funding at age 50, which is 15 years. Now, can I adjust the funding amount? The answer is yes. You could adjust the funding amount with both of them. Here's your flexibility. The base premium is typically contractually required. So, with this guy, I have a range to fund anywhere from $11,000 per year up to $30,000 per year. So I do have some flexibility. I am not obligated to pay that $30K every single year. Whereas with the 15 pay over here, my minimum, $3,000 with the term rider, it's going to come out to $35. I'm just going to round up to $4,000. That's probably my true all-in minimum, and I can fund up to $30,000 per year. So I have more flexibility because I can carry a lower minimum premium and more cash value. Also, the premium with this option does credit more money to cash value than the premium over here with this option. See where it's beneficial to have awareness of the different products that are available? Very beneficial. So you do have flexibility to adjust. With MassMutual specific rules, it's very easy to adjust one time per year on your policy anniversary date. All right, and then the option to stop funding early. Is this possible? Yes, it is. So we've got the illustrations, but for the sake of simplicity, we're going to look at them on Excel. So year 4, your cash value is $121 with the 15 pay and $95.4 with the whole life 100. Have those numbers in mind? Cool. Here's your whole life 100. After 4 years, we assume you pay nothing. Life happens. You can't pay. Or you might just not want to anymore. So you pay 0 in, break-even point, a ways down the road. The cash value goes up with no out-of-pocket, but man, it grows slow. Compared to your 15 pay product, you're breaking even in the 4th year, you pay nothing, grows at a much faster rate, and you've got a lot more cash value long term. Interesting, isn't it? If you carry a low premium, it allows the policy to grow at a faster rate if you want to pay 0. If you have a low premium, it allows the policy to grow at a faster rate if you pay 0. Because if I'm using the dividends and interest to support my premium, the lower that premium is, the better. This is especially true when looking at the guaranteed cash value. All right, those are the different funding options. Let's wrap this puppy up by looking at some loan scenarios. What we're going to look at here is the 15 pay product. We're going to take out a loan of $500,000. We're going to assume we pay off the mortgage in full, and we're going to see what the policy looks like if I don't pay my loan, pay interest only, and then pay the loan in full. Let's take a look. So, to kick things off, we've got the 15 pay policy. On the left, we've got growth only. Anytime we look at a loan illustration, I'm a huge fan of focusing on growth first. This way, I can see the direct impact that that loan has on my policy, both the cash value and the death benefit. So in this example, we're taking a loan down here. So if I look at this guy at age 51, my cash value is $668. My death benefit is $1.353. Over here, I take a $500K loan. There's my loan balance. My cash value is my available equity that I can access, just like a line of credit on a piece of property that you own. So while you borrowed $500,000 and you've got equity remaining of 142, you still earned dividends and interest on the full 668. So you get compounding on everything. That's why people are attracted to this. Now we've got to factor in the loan interest here. But there's your death benefit. 853. In the example where I never touched it, it was 1.353. 1353 minus 500 is 853. You'll always see your death benefit collateralized dollar for dollar, meaning the insurance company is on the hook for that much less. If you die with a loan outstanding, that is a big reason why and really how they continue to pay you dividends and interest on your full cash value. So when we look at this guy, what's important to do is see what a policy looks like if you never pay the loan back and if you never pay any loan interest. Really what I'm interested in seeing is making sure that cash value never goes down. Now, in this case, it's not going to go down because we had a ton of cash value prior to borrowing that $500,000, and we've got a ton still there after we take that loan. So the interest earned on the policy is going to exceed the interest being accrued via the loan interest. However, it does slow the growth down. Like if I look at age 70, if it's me, I would say, okay, I paid in $450. That was the $30K per year for 15 years. I took out $500,000. So it feels like I've got a $50,000 gain. Sweet. And then if I look at age 75, or I'm sorry, age 70, I also have another $450. So I might feel like I've got $500 in total value in that particular case. Maybe just the $450, depends how you view it. But it's still a win. Like that's how I would look at it. And I've got life insurance. But if I compare it to the example on the left, well, I paid in $450 and I've got $1.8 million. So paying the loan definitely has some advantages, but it depends on my situation in life. If I'm retired, I might not want to pay that back at all. Paying interest only. Exact same situation here. I take the $500K loan. You'll see the impact that it has on your cash value and death benefit, identical to the first example. And then in this example, we are paying the loan, we're paying interest only, and that's it. You'll actually notice that the death benefit will always be exactly $500,000 less than what you see over here, the death benefit with no loans. But this assumes you pay interest only forever. It could be interest only for a few years and then you stop, like that's very possible. You've got a ton of flexibility, but let's look at the good one and we'll wrap up with this. Loan and repay. Light blue is your loan payment. Purple is your loan principal payment. Orange is your interest payment. Here we go. There's your $500K loan. There's the impact on your cash value and death benefit. Then we begin to repay it at $60K per year. You can see how much is applied toward your principal and how much is applied toward your interest. And when it is repaid, cash value, death benefit, compared to cash value, death benefit. In the example where I never touched it. Money kept compounding. That's where people use it. The last thing I would probably do here for our analytical clients is tally up the total interest and also tally up the total interest earned over time to see which one's greater. By far, it's going to be the interest earned because I've earned interest on my entire cash value and I've paid interest only on my outstanding loan. But it is beneficial to see that. Those who really want to understand the numbers before they make a decision, is this for me? That's helped them. So I hope this has helped you. I hope you have enjoyed it. Please let me know your thoughts below in the comments. And as always, I hope this helps.